Hi everyone. In this video, I'll group stocks into different levels. There are many ways to judge a stock, so keep in mind this is just a basic guide. Usually the lower the level, the smaller the company. Let's start with level 1, the bottom or meme zone. This level is for small companies. It includes meme stocks that are very popular right now or companies that might be kicked off the stock exchange. These businesses usually make no profit and are hard to trade. Wall Street often bets against them. People buy these stocks for two reasons. They either know the business very well or they are gamblers, hoping for a quick profit. Normal math-based analysis doesn't work here. The price changes because of social media hype or of the fear that the company will go bankrupt. Level 2. Small fish or speculative play. These are companies worth a few $billions. They usually don't make a profit yet and rely heavily on one thing, like a single patent or piece of technology. Examples include early startups in biotech, AI, or clean energy. Their future depends on one event, like a new drug being approved or winning a big lawsuit. Why do people buy them? They hope to find the next Amazon. But be careful, you could easily lose 90% of your money. These companies might not have any steady income yet, or their sales might be very unpredictable. Level 3. The Crossroads. At this level, we find two types of companies. Distressed, those in trouble, and promising, those growing fast. The troubled companies. These are large companies with big problems. Some are like zombie companies. They make money, but almost all of it goes to paying off massive debts. Example: Warner Bros. Discovery, a media empire with colossal debt struggling to survive the streaming wars. Other companies here are losing market share or growing too slowly, 3 to 4% a year. Since inflation is often higher, they are stagnating. At this stage, looking at the PE ratio is useless. Instead, P to S and debt to EBITDA are the rules here. The danger, the value trap. This is the most dangerous predator for investors. You see a low P to E or a high dividend yield, 8 to 10%. You think it's undervalued, but it's a trap. The stock is cheap because the business has no future. The rising stars. These are promising companies with soaring revenue. They have proven their product works, but they are still burning cash to scale. Rocket Lab, SpaceX number one contender. The good. Revenue is growing by about 50% annually with a $1 billion backlog. The problem, they are still unprofitable. Everything depends on the Neutron rocket launched late 2026. If Neutron succeeds, it's a ticket to level 4. Rivian, the moment of truth. The good. Their February 2026 report is strong. They are moving to the mass market with the R2 SUV. The problem, monstrous burn rate. They might lose $2 billion EBITDA in 2026. They have $6 billion in cash, which is enough for about a year. Summary of Level 3. Rocket Lab and Rivian are the opposite of zombies. They have energy and growth, but they are at Level 3 because their survival depends on one product, the Neutron rocket or the R2 crossover. These are investments in hope backed by real factories. Before we move to the next level, please like the video and subscribe to the channel. It really helps. Now let's continue. Level 4. The golden mean. Profit and revenue growth here is around 8 to 10% per year, which is the market average. These companies have a strong moat, but they aren't monopolies. They share the market with a few other strong players. They have enough cash to buy smaller competitors or pay moderate dividends, 1 to 2%, while still growing. Examples of Level 4 companies. MasterCard, a Level 4 classic. It grows along with global spending. When inflation rises, their fees rise too. Revenue growth in 2026 is projected at 10 to 11%. It's a very reliable business that simply does its job. Pepsi. Pepsi is doing great in the snacks segment, Lay's Doritos. Revenue growth is steady at 7 to 9%, and EPS is growing because the company is becoming more efficient. This is an okay company for people who want to sleep well at night. Costco. A retail giant with a unique club model. Sales growth in 2026 is stable at around 9%. Huge customer loyalty protects them from Amazon and Walmart. At level 3, we are wondering if a company like PayPal would survive. At level 4, we are simply counting profits. These companies are too big to grow fast, but too efficient to fail. Level 5, the good fellas. These companies grow faster than the market, about 50% per year. Usually they have beaten the market average over the last 5 years. They have excellent credit ratings and plenty of cash to either buy other companies or invest heavily in R&D. Examples of companies at this level. ServiceNow, a star in enterprise software. They automate work for almost all major corporations. Revenue growth is steady at 20% with very high margins. This company beats the market nearly every year. Broadcom, a key player in AI and network infrastructure. Thanks to buying VMware and leading the market in data center chips, their revenue and dividends are growing much faster than the market. Amazon. In 2026, Amazon is much more than just a store. AWS and advertising bring in most of the profit and drive 15 to 17% growth. They have the resources to enter any new niche, from healthcare to Kuiper satellite internet. At this level, PE ratios are often high. The market knows these are great companies, so you have to overpay for quality. For an investor, the goal here is to wait for a correction to buy these good fellows at a fair price. Level 6. Almost masterpieces. These are giant companies. Their EPS and revenue grow much faster than the market, 50 to 20%, and they have tens of billions of dollars in cash. They are almost always in the top 20 largest companies in the world. However, they all have one flaw that keeps them from being perfect. This flaw could be a legal battle, a monopoly lawsuit, dependence on a risky region, or an unpredictable leader. Meta platforms. Strengths. Incredible margins, 18 to 20% revenue growth thanks to AI ads and billions in cash. Weakness. Constant lawsuits from the US and EU over privacy. Also the black hole of Reality Labs, the metaverse, where billions are spent with no clear profit date. Investors worry Zuckerberg might spend too much on risky ideas. Tesla. Strengths. Leader in electric vehicles, massive investments in AI and Optimus robots. They have higher margins than any other car maker and a huge cash cushion. Weakness. The stock is extremely volatile because of Elon Musk. In 2026, his active role in US politics creates extra risk. This scares some big investors and creates pressure from regulators in China and Europe. ASML. Strengths. A total monopoly on the machines needed to make the world's most advanced chips. Without them, AI progress is impossible. Profit growth is 20% plus. Weakness. They are stuck in the middle of trade wars. The US government constantly restricts their sales to China. Since China provides 20 to 30% of their revenue, a large part of their business is always at risk due to politics. At level 6, you aren't buying a business. You're buying a business plus a specific big risk. Level 7, the major league. These are the best of the best. These companies grow their revenue and profit by more than 20% a year. They have an excellent moat and a net profit margin above 30%. Most importantly, they lead the biggest global trends. NVIDIA. NVIDIA is the leader of the decade's main trend, artificial intelligence. Why it's ideal? In 2026, their Blackwell chips are the world standard for all data centers. Metrics. Revenue growth is stable at 25 to 30%, and their net profit margin is a massive 45 to 50%. Mod. The CUDA software. Programmers have used it for decades. Switching to other chips would be like the whole world trying to change its language overnight. Microsoft. The only giant from the past that has become the absolute leader of the future. Why it's ideal? They put AI copilot into every office task. They lead the trend of labor automation. Metrics. The Azure cloud business is growing at 20% plus, and the company's overall net margin is steady at 35 to 38%. Mod. The ecosystem. If a business uses Windows, Azure, and Office, it is almost impossible to leave. The switching cost is too high. Eli Lilly. This company leads the trend of fighting obesity and extending life. Why it's ideal? Demand for their drugs is so high they cannot build factories fast enough. Metrics. Revenue growth in 2026 is expected to be 22 to 26%, and profit margins are rising above 30%. Mod. Patents. No one can legally copy their medicine for many years. This allows them to set their own prices worldwide. At level 7, there are no trade-offs. You don't have to choose between growth and profit. You get everything. These companies keep 30 to 50 cents of net profit for every dollar they earn, yet they grow faster than startups. So, we've traveled from the bottom level, where you only hope for a miracle, to the major league, where companies print money with 30% margins. But remember, the secret to a good portfolio is balance. Don't just chase miracles, and don't just follow the giants. Find your own mix. Thanks for watching, and good luck with your investments.